Welcome back to the deep dive. Our mission, as always, is pretty straightforward. We take all this complex stuff, white papers, legal docs, tech specs, and, well, we boil it down into what you really need to know.
Yeah, cut through the noise.
Exactly. And today, we're tackling a big one, the XY ecosystem. Honestly, this might be one of the most layered Web3 setups we've looked at, just mechanically intricate.
Oh, absolutely. It's almost like complexity as a feature, using it for security, for transparency. This isn't just some simple DeFi game. It's a whole ecosystem trying to build this like closed loop economy.
Around what specifically?
Around a daily lottery, yeah. But also layered digital asset ownership NFTs and a very, very tightly controlled token.
XYU.
Right. So our job today is to pull all that apart. We need to get into the nuts and bolts of XYGO, that lottery. How does it actually prove it's fair? That's a big claim.
A huge claim. And we need to map out the money flows from those NFTs, the different layers.
And definitely the tokenomics.xyu. You said tightly controlled? Sounds like scarcity is the name of the game there? Very much so. Retention and scarcity. Okay, so the quick overview for you. The big idea is to mesh daily on-chain gameplay with owning something durable, these NFTs.
All on BNB Smart Chain.
Yep, BNB Smart Chain. And it's all run by smart contracts. The idea is trustless. You don't need to trust a central company, supposedly.
So the core pieces are?
Three main things. XYGO, that's the lottery game. Then the layered NFTs, which are basically deeds to parts of the game grid. And the XYU utility token, the fuel for the system, the vision. Transparent, rewarding, and scalable. Play, own, earn.
Okay, but the thing that really hooked us, the thing that makes this different from like almost every other Web3 lottery out there, it's how they deal with trust or randomness, really.
Exactly. Most lotteries, even decentralized ones, have some kind of internal random number generator, right?
Yeah.
An oracle, a black box, you just have to.
Well, trust? This project says no thanks to the black box.
Totally. They tie the most critical function, picking the winner, the randomness, to publicly available real-world financial data.
Which is kind of genius if it works.
Okay, let's unpack that. How on earth do they generate randomness using the stock market? All right, let's start with XYGO, the game itself. You mentioned a grid.
Yeah, a massive one, 1,000 by 1,000 coordinates. So that's, what, 1 million unique spots players can choose?
1 million potential winning locations each day. And how much to play?
The standard ticket is 3 USDT. That's the stablecoin entry. Keeps things predictable.
Or you mentioned the XYU token equivalent.
Right. Or you can use XYU, but there are specific conditions. Very specific.
Okay, let's pin those down later. First, the timing. It's daily, but tied to.
Tied completely to the traditional financial markets. Draws only happen when both the NYSE and NASDAQ are open for business.
So no weekend draws, no holidays.
Nope. If you buy a ticket on a Saturday or a market holiday, it just automatically rolls over to the next trading day. Your ticket's still valid.
And the cutoff time for buying tickets each day. It's precise, 3:30 CM Eastern Time. That's exactly 30 minutes before the U.S. stock markets close. After 3:30, no more tickets for that day's draw. Entries are locked, and the system waits for the market data.
Okay, let's circle back to those XYU tickets. You said there were conditions. What are they?
Two main ones, and they're strict. First, you have to buy at least one USDT ticket that same day. Can't just use XYU.
Ah, so they guarantee some stablecoin revenue each day, regardless.
Exactly. Ensures the core prize pool is funded by USDT. Second condition, year limited. Max of 10 XYU-based tickets per wallet per draw.
10 XYU tickets max after buying at least one USDT ticket. Got it. But here's the kicker, right? These XYU tickets, they don't compete for the main daily prize.
Correct. This is crucial. XYU tickets are only eligible for the jackpot prizes, not the regular daily prize pool funded by the USDT sales.
Okay, so why structure it like that? What's the thinking?
It's clever economics, really. It pushes the use of XYU towards the big, high-risk, high-reward play chasing the jackpot. This drives XYU usage and, as we'll see, drives token burn.
While keeping the main daily prize pool safe, funded only by stablecoins.
Precisely. It prevents the system getting flooded with XYU rewards or people trying to game the daily payouts with the utility token. It walls off the stable capital.
Makes sense. Protects the core revenue. Okay, now for the main event. How do they get rid of that centralized random number generator? The provably fair part.
They do it by tying the outcome entirely to two pieces of public verifiable data. The closing value of the NASDAQ Q Composite Index and the closing value of the NYSE Composite Index.
Right, the stock markets. But those numbers are huge, like thousands of points. How do they get a coordinate from 1 to 1,000 out of that? That conversion seems critical for trust.
It is, and the method is about truncation, focusing on the least predictable part of the number. For the x-coordinate, they take the last 3 digits of the NASDAQ closing value. And importantly, this includes the 2 digits after the decimal point.
The last 3 digits, including the cents, basically.
Exactly, and the y-coordinate, same logic, but using the NYSE closing value. Last 3 digits, including the 2 decimals.
Okay, walk us through that example again, nice and clear.
Sure. Let's say the NASDAQ closes at 12,345.67. The last 3 digits are 5, 6, and 7, so X is 567.
Okay.
And if the NYSE closes at, say, 33,210.89, last 3 digits are 089. So Y is 089.
Meaning the winning coordinate for that day is 567,089.
That's it. That closing data is public, everyone can see it, it's immutable once confirmed, the smart contract just processes it.
All right, now let's get into the why a bit deeper. Why specifically those last 3 digits? Like you said, the NASDAQ could be 13,000, 14,000. Why ignore the big number and just use the tail end?
Yeah, it's a really good question. It seems like a deliberate choice for cryptographic strength. By using only those last 3 digits, especially the 2 decimal places, they achieve a couple of things.
Okay, like what?
First, it cuts down the influence of the big overall market movements. Whether the market was generally up or down by a large amount doesn't affect those last digits as much. They're less predictable based on general trends.
Right, it isolates the noise from the signal, in a way.
Kind of. And second, it focuses on the most volatile part, those final decimal places that can fluctuate quite a bit in the last minutes of trading. To actually manipulate the specific 3-digit outcome, you'd essentially have to manipulate the entire market close precisely.
Which involves billions of dollars and regulators everywhere.
Exactly. It makes predicting it cryptographically near impossible and manipulating it economically just prohibitively expensive. So they're leveraging the integrity of the whole financial market as their random beacon.
That is pretty elegant, using the inherent chaos, or at least the micro-volatility, of regulated public data. Okay, but what if something goes wrong? Data feeds fail, numbers get corrected after the close. It happens.
They've got a plan for that. It's detailed pretty well. They use secure oracles to get the data, obviously. If the main one fails, or if an exchange issues a correction after the draw should have happened.
Then what? Backup plan.
Yep, a tiered fallback. First, they check the official Refinitiv feed. If that's also unavailable after, say, 24 hours, they move to the Bloomberg official closing data.
And if that fails, after 48 hours.
Then the draw for that day is canceled. Full stop. All the tickets purchased for that draw just automatically roll over to the next valid trading day.
And all this is tracked on-chain.
Supposedly, yes. All delays, cancellations, rollovers recorded transparently so everyone can see why a draw was delayed or canceled, builds trust.
That level of backup is necessary, I suppose. Okay, let's follow the money now. 100% of the daily ticket sales, the USDT ones, get allocated immediately. How does that break down?
Right. It's split into 3 main buckets. The main prize pool, the jackpot system, and what they call the ecosystem allocation.
Let's start with the biggest chunk, the main prize pool. That's 65% of the daily USDT take, right?
Correct, 65%. And that pool itself is then split across the winning layers based on how big those layers are. 70% of that 65% goes to winners in the winning layer 1 zone.
The biggest zone.
Yeah. Then 20% of the pool goes to winners in the layer 2 zone, and the remaining 10% goes to winners in the smallest layer 3 zone.
And how is it shared among winners within a layer?
It's proportional. If you bought, say, 10 tickets in the winning layer 3 zone and someone else bought 5, you'd get double their share of that layer 3 prize allocation.
Okay, proportional share. Now, there's a specific detail about how the layers stack up. If my ticket is in the winning layer 3 spot, it's also automatically in the winning layer 2 and layer 1 spots for that same coordinate, isn't it?
Exactly right. The documents are clear. A layer 3 winning ticket is eligible for payouts from the layer 1 and layer 2 prize pools as well, based on its proportional share within those larger winning zones.
So one lucky ticket could potentially get a piece of all 3 prize pools simultaneously.
Yes, it definitely incentivizes players to aim for those more precise layer 3 coordinates because the potential payout stack is bigger.
What if a winning coordinate is drawn, but say nobody bought a ticket in the layer 2 zone for that area? What happens to that 20% of the prize pool?
That's the rollover rule. It's designed to keep the jackpots growing. If no tickets are found in a specific winning layer, whether it's L1, L2, or L3, the entire prize money allocated for that layer gets transferred directly into the main jackpot.
Okay, so unwon daily prizes feed the big one. That makes sense.
Insurance funds don't just disappear, they accelerate the jackpot growth.
Speaking of which, the jackpot system gets the next 20% of daily USDT revenue. How is that 20% divided?
It's split. 15% goes into the main jackpot and 5% goes into seeding the mini jackpot.
And the main jackpot that's only won by?
An exact coordinate match. Using our earlier example, you'd have to have bought a ticket specifically for 567,089, not just in the layer 3 zone, but that exact spot.
High precision needed. And if someone hits it,
They win the whole main jackpot amount. Well, almost. There's a 10% deduction first.
okay, where does that 10% go? Fees.
No, it's split. 5% goes straight to the NFT holders whose digital land contain that winning coordinate, distributed across the L1, L2, L3 owners for that spot.
Reinforcing the NFT value proposition. And the other 5%.
That goes to the affiliate. The person whose referral link the winner used to sign up rewards growth.
Right, the affiliate system. We'll get more into that. Now, critically, after someone wins the main jackpot, what happens? Does it reset to zero?
No, and this is clever. The current mini jackpot immediately gets promoted. It becomes the new main jackpot. And a brand new mini jackpot starts building up again from that ongoing 5% daily allocation.
Ah, so the main jackpot never actually drops to zero. It just resets to whatever the mini jackpot had grown to.
Exactly. It avoids that psychological slump you see in traditional lotteries after a big win. There's always a significant jackpot amount visible, which helps keep players engaged.
Smart design. It institutionalizes the excitement. Okay, that covers 65% plus 20% plus 85%. What about the last 15% of the daily USDT intake?
That's the ecosystem allocation. It's split 3 ways evenly. 5% goes to NFT zone yield. That's another income stream for NFT owners we need to discuss. 5% goes into an operational reserve for platform costs, security audits, gas fees, that kind of thing.
And the final 5%.
Affiliate commissions, paid out monthly based on referral activity. So that's the full 100% of the USDT ticket sales, all allocated automatically by the smart contract.
Okay, so if XYGO is the engine driving daily activity, the NFTs are like the real estate, the ownership framework. This is how the system tries to monetize attention and give people a long-term stake.
And it's layered, just like the prize pool. Dividing up the digital grid into different ownership zones, how does that 100 by 1,000 grid break down for NFTs?
It's hierarchical, 3 layers nested inside each other. You own a zone, but that zone is also part of a bigger zone in the layer above it.
Okay, start at the top, layer 1, the biggest pieces.
Right, layer 1 is just 4 NFTs in total. Each one covers a huge 500 by 500 area, basically a quarter of the whole map.
Wow, only 4. What was the initial price on those?
They were priced initially at $150,000 USDT each. Big investment, broad coverage, but low precision,
Makes sense. Then layer 2, more granular. Yep. Layer 2 has 100 NFTs. Each covers a 100 by 100 coordinate zone. So these fit neatly inside the layer 1 boundaries. Initial price for these was $18,000 USDT.
Okay, 100 by 100. And the most precise layer, layer 3.
Layer 3 has 400 NFTs. Each covers a 50 by 50 coordinate zone. These are the smallest, most granular ownership plots. Initial price was $9,000 USDT.
So 50 by 50. And the key thing is, every single coordinate on that million spot grid falls within exactly one layer 1 NFT, one layer 2 NFT, and one layer 3 NFT.
That's the structure. Every spot has 3 landlords, essentially, at different scales.
All right, so if I own one of these NFTs, how do I make money? What are the income streams? The docs mentioned 3.
Yeah, 3 main ways. First, and probably the most consistent, is the ticket sales royalty.
We touch on this. 5% of every USDT ticket sale goes to NFT holders.
Exactly. That 5% is allocated based on where the ticket was bought, but it's split across the layers covering that spot. 0.5% of the ticket price goes to the layer 1 NFT owner for that zone.
Okay, 0.5% for L1.
Then 1.5% goes to the layer 2 owner, and the biggest slice, 3%, goes to the layer 3 owner.
Well, wait, so layer 3 gets 3%? Layer 1 only gets 0.5%. That's a 6x difference.
It is. It heavily weights the rewards towards the owners of the smallest, most precise zones. Even though L3 covers a much smaller area, its rate of earning from each ticket sold in its zone is much higher.
Definitely incentivizes owning those L3s if you expect high activity in a specific small area. Okay, that's stream 1. What's the second?
Stream 2 is the jackpot payout share. Remember that 10% deduction from the main jackpot win? 5% went to affiliates, the other 5% goes here.
Ah, right. Shared among the NFT owners in the winning spot.
Yes, using the exact same percentage breakdown as the ticket royalties. 0.5% of that jackpot share goes to the L1 owner, 1.5% to L2, and 3% to L3. So NFT owners get a piece of the biggest wins happening on their turf.
Aligns their interests with player excitement.
Okay.
And the third stream, something about LP unlocks. Sounds more DeFi.
It is. This one ties into the liquidity protocols we'll discuss later. It's called the LP unlock share. Basically, when the protocol unlocks some of its own liquidity pool funds, 25% of the USDT portion recovered is specifically earmarked for NFT holders.
Okay, 25% of the protocol's recovered USDT. How is that split among the L1, L2, L3 owners?
This split is even more skewed towards the higher layers. For this stream, 10% goes to the relevant Layer 1 NFT holder, 30% goes to the Layer 2 holder, and a massive 60% goes to the Layer 3 holder.
60% for Layer 3. Wow. Okay, so the daily activity rewards, ticket sales are weighted 0.51, 0.53, but the big capital recycling rewards from the DeFi side are weighted on 30-60.
That's it. It makes Layer 3 NFTs potentially very valuable, not just from ticket volume in their small zone, but disproportionately from the overall health and capital cycling of the entire ecosystem.
So owning an L3 gives you high sensitivity to local activity and the largest share of the system-wide capital returns.
Interesting. And all these payouts are automatic via smart contract.
Claimable on-chain, yes.
Yeah.
Calculated and distributed automatically. Okay, let's talk about buying and selling these NFTs. The life cycle. Primary sale first.
Right. The very first sale of each NFT from the project itself must be paid for in USDT, stablecoin only.
And that USDT payment does something important, right? It's not just revenue.
It's the trigger for minting XYU tokens. The inflow of that real-world capital, USDT, is what actually creates the corresponding batch of XYU. It directly backs the token's initial existence.
So USDT comes in, XYU gets minted. Now, once an NFT exists and someone owns it, how do they resell it? What currency is used on the secondary market?
This is a key utility driver. Once minted, these NFTs can only be bought and sold using XYU tokens, period. They have an integrated marketplace for this, supporting auctions and fixed prices.
Only XYU for secondary sales. That forces demand for the token if you want to get into the ownership layer after the initial mint.
Absolutely. And there's more. Every secondary sale also has a 5% royalty fee. And guess what? That fee is also payable only in XYU.
More forced XYU demand and usage. Okay, now the vesting. This sounded pretty aggressive for the initial NFT buyers. You'll get a bonus XYU allocation.
Yes, substantial amounts depending on the layer.
Huh.
Up to 750,000 XYU for buying a Layer 1 NFT initially. But, and it's a big but,
Here it comes.
it's all subject to extremely long vesting. A 12-month cliff, meaning 0 tokens unlock for the first full year.
1 year cliff. Ouch. And after the cliff.
And then it unlocks linearly over the next 48 months, 4 years.
So a total of 5 years before the initial investor gets their full XYU bonus allocation. That seems incredibly long for a Web3 project. Isn't there a risk people just won't stick around, especially team members or big investors facing that cliff?
It's definitely a major commitment they're asking for. The documentation pitches it as absolutely essential for long-term stability to prevent early dumping, ensure alignment.
So they're prioritizing stability over maybe attracting more hype or faster-moving capital.
Seems like it. They're basically filtering for very patient capital and team members. The risk of losing people during that long lockup is real, no doubt, but the potential benefit is massive token scarcity and reduced sell pressure during the crucial early years.
A calculated gamble on long-termism. Okay, one more critical detail. If that initial investor sells their NFT on the secondary market during the vesting period, do they lose the rest of their unvested XYU tokens?
No, and this is important. The docs state the initial investor keeps their right to the full vested XYU allocation according to the schedule, even if they sell the NFT itself.
Ah, so the long-term token reward is tied to their initial capital contribution, not continuous ownership of the NFT asset.
Exactly. It separates the investment return, the vested XYU, from the asset trading aspect, the NFT.
Okay, so we have the game, XYGO, and the ownership layer, NFTs. Now let's dive into the bloodstream, the XYU tokenomics. The core idea seems to be avoiding inflation at all costs. No printing unbacked tokens.
That's the absolute foundation. It's a fixed supply model, hard cap of 1 billion XYU tokens, ever.
And as we just discussed, new XYU is only created when?
When an NFT is sold for the first time, for USDT, the amount of XYU minted is directly tied to the amount of USDT that came in for that specific NFT sale.
Can you remind us of those minting numbers again per NFT tier?
Sure. A Layer 1 NFT sale, 150K USDT, mints 25 million XYU. A Layer 2 sale, 18K USDT, mints 3 million XYU. And a Layer 3 sale, $9K USDT, mints 1.5 million XYU.
So you add all that up across all 504 NFTs,
Yep.
and that's how you eventually reach the maximum possible 1 billion supply.
Huh.
Only if every single NFT sells.
Precisely. The total supply can only reach its maximum if the full amount of required external capital, 150K 4 plus 18K $100 plus 9K 400 per $6 million USDT total has entered the system via primary NFT sale.
That's fundamentally different from tokens that just inflate over time through rewards.
Okay, so assuming all NFTs eventually sell and the full 1 billion XYU exists, how is that total supply allocated? Where do the tokens go? The distribution plan is very detailed, clearly designed to manage supply and incentives over the long haul. The lion's share, 71%, is earmarked for something called the SL Meaning Protocol and burnable in-game bonuses.
SL meaning. That's the shared liquidity thing we need to cover later.
Exactly. This massive pool is used to match user liquidity deposits and also to fund those non-transferable rewards that get burned. It's the main operational reserve for the token economy.
Okay, 71% there. What else?
10% is allocated specifically for liquidity pools. And crucially, this 10% is the only part that's fully unlocked right at the token generation event, TGE. Ensures there's immediate trading liquidity from day one.
Makes sense. Need a market.
Then another 10% is for the team and advisors, but this is subject to that really strict vesting. 12-month cliff, then 48 months linear release.
A 5-year plan again. Okay.
5% is set aside for a growth acquisition fund. This one has a unique rolling vest. Only 1% of this fund unlocks each month, and only during a specific 6-hour window. If they don't use the unlocked portion within those 6 hours, it rolls over to the next month.
Why the 6-hour window? Seems oddly specific.
It's likely to prevent large, unexpected dumps onto the market from the growth fund. It forces planned, transparent usage within a very tight time frame each month. Control.
Okay, what's left?
3% goes to those initial NFT investors, again, subject to their 12-month cliff and 48-month vest. And the final 1% is for the GOXY community airdrop. These rewards are distributed gradually as the NFTs are sold, not all at once.
Wow. Okay, so across the board, except for that initial 10% liquidity, almost everything is locked up for a very long time or released very gradually. The emphasis is clearly on preventing early supply shocks.
Definitely. Minimizing early speculative pressure seems paramount. Now let's talk utility. What can you actually do with XYU, and more importantly, how does it get removed from circulation, the burning mechanisms?
Right. Primary uses are
Betting specifically for getting eligibility for the jackpots, remember, not the daily prize pool. And second, it's the only currency for all secondary market NFT trades and the associated royalties.
okay, betting and NFT trading. But you mentioned a cashback and burn loop linked to the USDT bets.
Yes, this is where it gets really clever, linking stablecoin activity directly to XYU scarcity. Every time someone buys a USDT ticket, they get a reward, 1 XYU token.
Okay, an incentive to use USDT. But there's a catch, isn't there, to prevent people just farming XYU.
Big catch. Only the rewards from the first 5 USDT bets you make each day give you transferable XYU. Tokens you actually own, can sell, can use freely later.
Only the first 5. So if I buy a 6th USDT ticket, I still get 1 XYU.
But that 6th XYU reward and any rewards from bets after that, plus other bonuses like daily streak rewards or onboarding bonuses, all of those are non-transferable.
Meaning I can't sell them, can't send them to another wallet.
Exactly. They're locked to your account. Their only use is to be spent back inside the game on XYU-based bets for the jackpot.
And when you spend those non-transferable XYU tokens on a bet,
They are 100% burned, instantly and permanently removed from the supply.
that is a fascinating closed loop. You incentivize USDT betting with XYU rewards, but most of those rewards can only be used in a way that destroys them, driving gameplay and burning tokens without flooding the market.
It's brilliant, really. It turns the reward mechanism itself into a deflationary engine. The reward encourages more play, which burns the reward. And this is amplified even further by the choices you have when claiming the transferable XYU you earned from those first 5 bets.
Ah, the vesting options for claiming. How does that work?
Great. When you go to claim your transferable XYU, you don't just get it all instantly. You have to choose a vesting period to maximize what you receive.
Okay, what are the options?
Option 1, claim 50% immediately. The other 50% just goes to the XYU Foundation, effectively burned from your perspective. Option 2, vest for 7 days and you get 60%. Option 3, vest for 3 months, get 80%. Option 4, vest for 6 months, and you get the full 100% of your earned reward.
So the system heavily incentivizes you to lock up your rewards for 6 months if you want the full amount.
Massively. It's not just preventing immediate selling, it's actively encouraging users to time lock their tokens, acting like a forced staking mechanism just to claim the rewards they already earned. Reduces floating supply dramatically.
Converts potential sell pressure directly into locked supply. Very clever.
Hmm.
Okay, and finally, the direct burn from high-volume XYU betting itself. The leverage ratio.
Yeah, the rule allowing up to 99 XYU bets for every 1 USDT bet made that day.
What's the purpose of that 99.1 ratio? Seems high.
It creates an internal market for risk. Players can use their accumulated XYU transferable or non-transferable to take highly leveraged shots at the big USDT jackpot. It gives XYU a specific high-stakes utility.
Risking the utility token for a chance at the stablecoin prize. And the key part for tokenomics.
The key is, every single XYU token spent on these bets, whether it was transferable or non-transferable originally, is 100% burned on use, gone forever.
So the more people chase the jackpot using XYU leverage, the faster the XYU supply shrinks.
Exactly. It creates enormous deflationary pressure directly proportional to player engagement with the jackpot system, while neatly isolating the core USDT revenue stream. It gives XYU a valuable use case, jackpot access, that simultaneously destroys the token, constantly reinforcing its scarcity. Okay, things get even more complex, but also quite innovative when we look at how this ecosystem manages its own liquidity. It's not just relying on external market makers. They have these internal DeFi protocols, starting with SL mining.
SL mining, shared liquidity mining. Okay, break that down. The goal is deeper liquidity, right?
Yeah.
But also alignment between users and the project.
That's the idea. It works like this. A user comes along and decides to provide liquidity. They deposit USDT. The protocol then automatically matches their USDT deposit with an equal value amount of XYU, taken from that big 71% SL mining allocation pool we talked about.
So, user puts in stablecoin, protocol matches with its own token. Then what?
Then that pair, the user's USDT and the protocol's XYU, gets locked together as liquidity on a decentralized exchange, probably PancakeSwap, given some BNB chain.
Okay, so it creates a standard LP, liquidity provider token, representing that locked pair. Who gets the LP token?
It's split. And the split depends entirely on how long the user agrees to lock their initial USDT deposit.
Longer lock means the user gets a bigger share of the LP token.
Exactly. For example, if you commit to a 12-month lock, you, the user, get 60% of the generated LP tokens, and the protocol keeps the other 40%. If you choose a shorter lock, like just 1 month, it's a 50-50 split.
So the protocol always retains a significant chunk of the LP token, especially for longer locks. Why do that? What's the benefit for the protocol or the system?
From a risk management view, it's pretty smart. By holding on to a share of the LP tokens itself, the protocol is essentially sharing the risk of impermanent loss with the user.
Because impermanent loss affects the value held within the LP token.
Right. So if the price of XYU fluctuates wildly, the protocol absorbs part of that potential loss or gain through its share of the LP. This makes the liquidity pools deeper and more stable because they're backed by both the user's capital and the project's capital, reducing volatility caused by short-term liquidity providers pulling out quickly.
It's a form of protocol-owned liquidity,
Yeah.
POL, but generated collaboratively with users. Okay, that keeps capital locked in. Which brings us to the recycling part. What happens when the lock period ends and the protocol's share of those LP tokens unlocks?
This is where the system becomes really self-sustaining, like a perpetual motion machine for capital. When the protocol's LP tokens unlock, the underlying assets, the USDT and the XYU, are immediately unwound, split, and routed according to a very specific automated logic. Let's do the USDT part first.
Okay, the USDT recovered from the protocol's unlocked LP share, where does it go?
It's split perfectly 4 ways, 25% each. First 25% goes straight to the treasury, covers future development, marketing, operational stuff.
Okay, treasury.
Second 25% goes to the NFT vault. This is the money that funds that third income stream for the L1, L2, and L3 NFT holders, the LP unlock share we discussed. Split winning out their 60.
Right, feeding the NFT owner rewards. Makes sense. Third 25%.
Third 25% is for buyback. This USDT is immediately used by the smart contract to buy XYU tokens off the open market.
Hold on, so it uses its own recovered USDT to buy its own token.
Yes, and crucially, the XYU tokens it buys back are then sent back into the SL mining pool.
Let's unpack that loop. That's the autonomous price support, isn't it?
Absolutely critical. Unlocked USDT stability capital gets converted back into XYU utility tokens through market buys, which provides constant buy pressure. And then that newly acquired XYU is immediately ready to be used again by the protocol to match new user USDT deposits entering the SL mining system.
Wow. So unlocking liquidity automatically generates funds to support the token price and replenish the pool needed to attract more liquidity. That's a powerful recursive loop.
It really is. It means the system can theoretically sustain its liquidity provision and price support without constant manual team intervention or relying solely on new capital inflows. Okay, and the final 25% of the USDT. The last 25% goes into the parking vault. This vault has one job: to fund the rewards for the parking protocol.
Okay, we'll get to parking in a sec. First, what happens to the XYU portion that gets unwound when the protocol's LP unlocks?
The XYU routing is focused on scarcity and replenishment. 5% of the recovered XYU is immediately burned, just destroyed.
More deflationary pressure. Good.
10% goes to the Treasury, alongside the USDT portion, and the vast majority, 85%, goes straight back into the SL mining protocol pool, ready to be paired with new user USDT deposits.
So most of the XYU just goes back to where it came from, ready for the next liquidity cycle, while a small amount gets burned permanently.
Exactly. This whole unwind and routing process for both USDT and XYU is designed to be this continuous, automated feedback loop. It converts static locked capital back into active capital that supports the price, funds rewards, and enables further liquidity growth.
Truly creating an economically self-sustaining cycle. If the core game activity, ticket sales, remains strong enough to keep feeding it initially. Okay, that brings us to the last piece of this DeFi puzzle, the parking protocol. You said it's their alternative to yield farming.
Yeah, traditional yield farming often involves the project constantly printing new tokens to pay out as rewards, which leads to inflation. Parking is designed differently.
So what do users park?
Users can lock up or park either their standalone XYU tokens or the XYUSDT LP tokens they might have earned from the SL mining protocol, their share.
Okay, they lock up their assets. Where do the rewards come from if not from printing new XYU?
This is the key. The rewards for the parking protocol are paid out exclusively from that parking vault, which, remember, is funded only by the 25% USDT share recovered from the protocol's unwound LPs.
Ah, so parking rewards are paid in USDT, derived from actual realized gains or recycled capital from the liquidity system, not from XYU inflation.
Precisely. It makes the rewards sustainable and non-inflationary for the core token. The system rewards people for locking up their XYU or LP tokens, reducing circulating supply, but it pays them from a separate pool of stablecoins generated by the ecosystem's own activity.
And presumably, the longer you park, the more rewards you get.
Yes, the reward calculations are weighted based on both the amount parked and the duration of the lockup. The stated goal is explicitly to reward patience and long-term holding over short-term speculation. Time itself becomes the currency for earning yield here.
All right, moving from the complex mechanics to the equally complex world of legal structures. For something involving a lottery, NFTs that generate income, and tokenomics, getting the legal setup right is absolutely crucial, isn't it?
Oh, massively. And they've gone for a very specific bifurcated structure. Two separate companies, clearly defined roles, designed to firewall liability.
Okay, let's break down the two entities. Who's company number one?
Company one is Trustless Web3 Solutions SA, and it's based in Panama.
Panama. Okay, and what's their job?
Their role is strictly defined. They are the intellectual property holder. They own the code, the smart contracts, the brand, all the core technology. They're also the technology provider and licenser. And critically, they oversee the main Treasury multi-sig wallet and set the token emission policy.
So Panama holds the keys to the tech and the Treasury policy. Why Panama?
Panama is a fairly common jurisdiction globally for holding passive assets like intellectual property. It offers certain advantages for international structures focused on IP ownership rather than active operations.
Okay, so that's the IP holder in Panama, who's company number two. The operational side.
That's Web3 Lottery Solutions Ltd. And this one is based in Anjouan, which is part of the Union of the Comoros.
Anjouan, right. A jurisdiction known for online gambling licenses. So their role is?
They are the licensed operator. They run the website, manage the players, handle the day-to-day operations, customer support, and, crucially, they hold the gambling license from the Anjouan Gambling Commission, AGC. They're responsible for all the frontline compliance, KYC, AML.
Okay, let's analyze this split. Panama owns the tech. Anjouan runs the licensed gambling operation. What's the strategic advantage here? Is it regulatory arbitrage? Liability shielding?
It's primarily about liability isolation, creating a legal firewall. If, hypothetically, the Anjuan operating company runs into regulatory trouble in a specific country it operates in, or faces legal action related to the gambling aspect.
The core intellectual property, the technology itself, and the token structure held by the separate Panamanian company remain protected, right?
That's the theory. It allows the core technology to potentially be licensed elsewhere or continue development, even if one specific licensed operator faces issues. It separates the tech asset from the operational risk.
Makes sense from a risk management perspective. What about governing the whole thing, making big decisions like changing the protocol?
For major decisions like smart contract upgrades or significant treasury movements, they require approval from something called the Smart Contract Multisig Council, or SCMC.
And that requires multiple signers.
Yes, typically a high threshold, like 4 out of 5 designated signers need to approve critical changes. Furthermore, the main treasury wallet itself is an even more secure 5 of 8 multisig.
5 out of 8. Who are the signers?
The documentation suggests they are directors and key personnel drawn from both the Panamanian IP company and the Anjuan operating company. This ensures neither entity can unilaterally control the core funds. Requires cross-company consensus.
Okay, robust governance. Now the big one, who can actually play?
Yeah.
The restricted jurisdictions list is, well, restrictive. No EU, no UK, no USA.
Correct. That's a fundamental compliance decision they've made up front. The platform is explicitly not available to users physically located in the European Union, the United Kingdom, or the United States. Also banned are North Korea, Iran, and any country on the FATF high-risk gray or black lists.
Wow. So they're locking out arguably the largest and wealthiest markets for gaming and Web3 right from the start. That's a huge chunk of potential volume gone. Why? Purely regulatory caution.
It seems to be exactly that. A conscious choice to prioritize regulatory certainty and avoid the massive complexities and costs of obtaining licenses and ensuring compliance in those major Western jurisdictions, at least initially.
Does the planning suggest they think they can make enough revenue from the rest of the world to sustain this complex economic engine?
The operational plan, focusing on those affiliate managers targeting specific non-Western markets, suggests they believe they can. They're aiming for rapid growth in areas where the regulatory path for this kind of platform is clearer or perhaps less aggressively enforced.
And they're serious about enforcing these bans. What about VPNs?
The user agreement is extremely clear. Any attempt to bypass the geo-restrictions using VPNs, proxies, or any other means is considered a material breach of the terms. The consequence: account termination and forfeiture of all funds and assets associated with the account. They seem very serious about this.
But they haven't completely closed the door on those big markets forever, have they? There's a mechanism for future expansion.
Right. The platform architecture is apparently built to be GDPR ready from the start. And the legal structure allows for future entry into places like the EU, UK, or US via regulatory annexes.
Meaning?
Meaning they could potentially add specific legal terms and conditions for users in, say, the UK once they obtain a UKGC license without needing to rewrite the entire global user agreement or force everyone else to reaccept terms. It allows for modular expansion into regulated markets later.
A future-proofing strategy. Okay, compliance isn't just about location. It's about AML and KYC, anti-money laundering, and know your customer. How are they handling that?
Their policy is stated to align with global standards, specifically the FATF recommendations, which is key for international legitimacy. It also needs to comply with local laws in Panama, Law 23 of 2015, and Anjuan's regulations.
Do they KYC everyone? How deep do the checks go?
They use a risk-based approach. Not everyone gets the same level of scrutiny. For smaller transactions, generally under $1,000 USD equivalent, they use what's called Simplified Customer Due Diligence, CD, basic checks.
But for bigger amounts or suspicious activity?
Then they escalate to Enhanced Due Diligence, EDD. This is triggered for transactions over $5,000 USD or cumulative activity reaching that level, or if any transaction looks unusual or suspicious, or if the user is flagged as a politically exposed person, PEP.
And EDD involves?
Much more thorough verification. Proving identity conclusively, verifying address, and importantly, understanding the source of the user's funds and wealth. They also mention using on-chain analysis tools like Chainalysis or Elliptic to assess wallet risk.
And they have someone responsible for this?
Yes, a dedicated money laundering reporting officer, MLRO, who monitors activity and is required to file suspicious activity reports, SARs, to the relevant financial intelligence units within 48 hours if necessary.
Okay, pretty standard high-level AML framework. What about data privacy? Handling all that KYC info.
They state compliance with Panama's Data Protection Law, Law 81 of 2019, and Anjuan guidelines. The privacy policy outlines what data they collect, wallet addresses, IP addresses for location checks, and the KYC documents needed for CDE.
And user rights, like GDPR.
They claim the framework anticipates GDPR-style rights, including the user's right to access their data, request corrections, and potentially request erasure, subject to legal retention requirements for AML purposes, aiming for compliance headroom for future expansion.
Okay, we've covered the game, the ownership, the tokenomics, the DeFi, the legals, but none of it works without users. Lots of users. How does this system plan to grow, especially given those geographic restrictions?
The primary engine for growth seems to be a very robust affiliate program. It's baked into the core design.
How does it work? Everyone gets a referral link.
Exactly. As soon as you sign up, you get your own unique affiliate link to share.
And if I get someone to sign up and play using my link, what's in it for me?
It's designed to be a lifetime incentive with two parts. First, you get a 5% commission on every single USDT ticket your referral ever buys. For life.
5% of all their ticket spend forever. Okay, that's pretty standard, but strong. What's the second part?
This is the more exciting one for affiliates. You also get 5% of every main jackpot your referral wins.
Whoa, so if my referral hits the big one for, say, $1 million, I get $50,000.
That's how it's structured, yes. Minus the initial 10% jackpot deduction, so 5% of the payout amount. It really aligns the affiliate's interest with their referrals' biggest successes. Makes them more than just a sign-up source. They're invested in their referrals actually winning.
Powerful incentive. What about the new user? What do they get for using my link?
They get a little welcome bonus, 3 XYU tokens, but crucially, these are non-transferable XYU.
Ah, the same kind you get from bets after the first 5.
Exactly. And there's another catch. They can only actually use these 3 bonus XYU after they've made their first real money bet using USDT.
So the bonus encourages sign-up, but it doesn't activate until the user puts actual stablecoin capital into the system, and then the bonus tokens just go into the burn cycle when used.
Right. It drives real revenue first, then provides a small taste of XYU utility that also contributes to deflation. Smart loop.
Okay, that's the basic affiliate system.
Yeah.
But they're taking it a step further, turning these affiliate streams into actual assets, right? The affiliate NFTs.
Yes, this is where it gets really meta, creating a secondary market for influence, essentially. Experienced affiliates, or anyone really, can choose to mint an affiliate NFT.
How? What's the cost?
The minting fee is the equivalent of 100 USDT, but it must be paid in XYU tokens. And following the pattern, all the XYU paid for minting is immediately burned.
Okay, so minting an affiliate NFT costs XYU and reduces the XYU supply. What does this NFT actually do for the owner?
It acts like a container for your referral network. When you mint it, the NFT becomes permanently linked to all your existing referrals and any future referrals you bring in while you own it.
And the benefit of linking them to the NFT.
The owner of the affiliate NFT receives that full 5% lifetime commission from both ticket sales and jackpot wins generated by all the referrals linked to it. And the commissions are paid out in USDT.
So the NFT becomes a yield-bearing asset, generating stablecoin income based on the activity of the attached referral base.
Precisely. It crystallizes the value of your affiliate network into a tradable digital asset.
Tradable. So I can sell my affiliate NFT to someone else.
Yes. They're designed to be traded on the XY market, the same place as the main layer NFTs. And importantly, they can only be traded using XYU tokens.
More forced XYU utility and demand. What happens to the referral income stream when the NFT is sold?
The new owner inherits all future income rights from the referrals permanently attached to that NFT. The original affiliate keeps any income earned before the sale, but the future stream transfers with the NFT.
So you're literally selling your future affiliate income stream. The value of the NFT would depend entirely on how active and successful your referrals are. Creates a market based on proven performance.
Exactly. It's like selling a small online business or franchise where the asset's value is tied to its demonstrable cash flow. And one more thing, just like secondary sales of the main NFTs, there's a 5% royalty fee on affiliate NFT resales, also paid in XYU.
Which also gets burned.
You got it. Burned. So affiliate NFTs drive XYU burn on minting and on resale while creating this fascinating market for network value.
That's Quite forward-thinking for monetizing network effects.
Hmm.
Okay, building this kind of referral machine and the whole ecosystem requires serious operational effort. What did the initial planning docs say about team structure and targets?
The initial team structure showed a strong focus on growth, specifically affiliate growth. They planned for 10 dedicated affiliate onboarding managers right from the start.
10 people whose only job is to recruit other affiliates, not end users.
Seems so. Their focus is described as attracting high-value, high-volume affiliate partners people or groups who can bring in significant numbers of players.
That tells you where they see the growth coming from. Leveraging existing networks, not just broad consumer marketing. Did they have specific targets for these managers?
Yes, quite aggressive ones. The goal was for these 10 managers collectively to onboard an average of 5 new high-value affiliate contracts per month.
5 major affiliates a month. That's ambitious. What was the user target tied to that?
The aim was to use this high-touch affiliate strategy to reach a critical mass of around 8,000 active daily users, with each user averaging about 2 ticket purchases per day within the first few months.
8,000 daily active players buying 2 tickets each. That's 16,000 tickets a day. That level of volume would be needed to really get those prize pools and DeFi recycling loops humming, wouldn't it?
Absolutely. That seems to be the target scale needed to make the economics work and demonstrate the model's viability quickly.
And finally, given the geo-restrictions, how are they planning to segment their marketing efforts?
The strategy outlined focuses on the non-restricted regions, breaking down the audience into 3 main groups. First, the crypto Web3 natives, people already in DeFi, NFT communities, blockchain gaming.
Obvious target. Who else?
Second, tech business and innovation influencers, people who might be interested in the novel mechanics, the provably fair RNG, the tokenomic structure itself, more of an intellectual angle.
Okay. And third,
a broader lifestyle and experimental audience. People who might just be drawn to the excitement of a daily lottery with potentially large jackpots, maybe curious about Web3 applications. And crucially, this targeting was planned to be immediately segmented by language with initial focus on content and outreach in English, Spanish, and Russian.
reflecting their primary target markets outside the USIC-EU block. Makes sense. Hashtag, tag, outro. Wow. Okay, that was definitely a deep dive. We've gone through the lottery mechanics, the multi-layered NFTs, the incredibly tight tokenomics, the advanced DeFi loops, the intricate legal structure, and the growth plans. A lot, but it all seems designed to fit together, doesn't it?
It really does. The complexity isn't random. It feels very intentional, very interconnected. For me, the coherence is maybe the most impressive part.
So let's distill it. Key takeaway 1 for you.
I think it has to be how XYGO tackles the lottery trust problem. Using public stock market data, specifically those volatile closing digits from NASDAQ and NYSE for randomness, that's a genuinely clever way to achieve provable fairness. It takes the black box out of the equation and gives you a result anyone can verify against public records. It effectively outsources the randomness generation to the integrity of the financial markets.
Removing the need to trust the operator for the core draw mechanic is huge. Okay, key takeaway 2.
For me, it's the economic architecture, how everything loops back and feeds into everything else. NFT sales mint the tokens. Ticket sales fund the prizes and the NFT royalties and the DeFi engine. The DeFi engine recycles capital to support the token price and fund more rewards. The token utility is tied directly to betting and trading, and using the token burns it. It's all interdependent, all driven by actual player activity, the USDT ticket sales. There's no magic money printer relying on inflation.
The whole thing is designed like a closed-loop system, trying to be self-sustaining based on that initial stablecoin input.
Okay.
Now, looking at that legal structure, the Panama IP holder, licensing to the Anjuan operator, and combining it with deliberately excluding huge markets like the US, UK, and EU, it paints a very specific picture, doesn't it?
It absolutely does. It's a calculated strategy for regulatory certainty. That legal firewall isolates the core technology asset from the potentially higher risk operational side in a specific gambling jurisdiction. It minimizes global regulatory exposure upfront.
Which brings us to our final thought, something for you, the listener, to chew on.
Yeah, this model separating the IP ownership and tech licensing, maybe in a place like Panama or Switzerland, from the actual day-to-day licensed operation, often in a place like Anjuan, Curacao, or Isle of Man. We're seeing this more and more in complex regulated Web3 projects, especially those touching gambling or finance.
So the question is this. Given how fragmented and uncertain crypto regulation is globally, does this kind of liability-isolating, jurisdictionally separated corporate structure become the default blueprint for any serious Web3 project aiming for long-term survival and regulatory peace of mind.
Even if it means consciously sacrificing access to the biggest consumer markets initially, is prioritizing the structural resilience over immediate market reach the necessary trade-off for building something sustainable in this space? How many future projects will adopt this IP offshore ops licensed model as just the standard way to do business in regulated Web3? Something to think about.